Hi everybody, this is Seth, and today is May 26th, Memorial Day, so happy Memorial Day to everybody out there. For those of you that have loved ones either in the military or have served in the military, or you yourself have been in the military, I just want to say happy Memorial Day and thank you for your service. Be sure to thank your kids, your uncles, or whoever you know that has served in the military. It's a big responsibility, and we need to, I think, honor those people as often as we can. So, happy Memorial Day to everybody. What I have on the screen here is the same chart we've been looking at for a while. This is the bull market since the March 2009 low, and as we've talked about before, it's trading inside of this what we call Rising Wedge, and you can go back to some previous videos if you want to hear more about the Rising Wedge. But in general, what happens on a Rising Wedge is it's a bearish pattern. You normally don't see them, mostly I'm looking for these on daily charts or something, not so much over this time frame. But this Rising Wedge, basically the way they work is when it breaks out, you have something like a 90+% chance that this will, resolve itself to the downside, and typically it will resolve itself by at least as much as the beginning distance of the Rising Wedge. So you can measure this distance here, you can add it to the breakout to the downside, and that's what you can expect. I'm guessing, somewhere around this October 2011 low, somewhere around this 1050 area. So that's what we're currently been looking at. I'm going to zoom in a little bit for now, and let me go back out for a second because I want to talk about these boxes and how we get these boxes. So let me zoom in. Zoom in here. So this box represents what we call resistance, and this box represents what we call support. Now these are technical analysis terms. What you'll find, at least on this channel, is we're going to be talking in terms of technical analysis. We're not going to talk really a whole lot in terms of earnings or expectations of company growth and things like that. I'm sure most of you have that kind of talk with your brokers and whatnot, and it's important, but right now we're just looking at the technical patterns. These technical patterns actually mean something, so we're gonna focus on that. So support's down here. It's a zone. It's not a number. It's just an area. And then resistance is up here. Same thing. It's an area, not a number. The way I've put these on the chart is I went to the last swing high, which is here, and then you just make a box just above that last swing high. Now we've actually gotten above this last swing high, but for the purpose of this discussion, even if I was getting a support zone off of this, it would basically overlap this box that I have on the screen. As for support, we're focused on this particular week right here. It's low, and this is the support zone for that low. And these are very arbitrary. I mean, the market just tends to move from, if you were to come back and create one off of this high back here, what you'll find is it intersects this zone right here. So what happened is the market pulled back. We already had our resistance on the chart. It would have been right along this 1888 area, and of course the market pulled back and it went right up to that area before it started trading sideways and actually pierced that area right here. So this is kind of the nature of technical analysis. Prices move from support to resistance, or from resistance to support, and we basically look for those zones on a chart. So anyway, that's on a weekly. So let me zoom in now to a daily chart. Look at a 6-month chart. And one of the things that I've got on the screen here is I've got actually a smaller wedge pattern forming here, potentially. I mean, it's hard to say. It's not as converging as the larger one, but it does seem to have moved into this wedge pattern, which is kind of a sideways and drifting up pattern. Now, today is again Memorial Day, which is Monday, and I'll switch over real quick, although I don't have my I'm not sure I have it lined up for this particular chart. Yeah, I guess you can see it here. So, you know, Friday was back here. The market closed right here, I guess, at 1896 on the futures, and you can see they popped up today when they opened. So the futures market was open today, but the actual stock market was not open today. But you can see here the futures popped up, kind of traded down, and continued up to this 1904. So, and you can see them moving right now. They're actually trading right now. It's currently 7:38 p.m. on Monday evening. So they're actually trading as we speak. So the market we should be looking for a gap up in the morning. Let's go back to this is closing data. So this day right here that I'm highlighting, that was Friday. So we should see a gap up into this resistance. We have a new closing high. Friday was a new closing high. It wasn't a new high. This day here was higher than this day here, but it closed higher than this day here. So it was a new closing high, but not a new high. So I suspect we're going to get a new high and a new closing high as we move into this zone of resistance. And of course, we could drift all the way up into this upper trend line before we pull back. So, or we could stop short. Maybe it just barely busts out of this little red wedge here and then comes back. So, you know, again, I said last week, if you're in the market, you know, you sit tight. We haven't seen any kind of movement outside of this wedge. There's no need to sell or buy puts or do anything to protect yourself in the market as of yet. We're still within the price range of this rising wedge, and so as long as we're within this wedge, and you're in a 401k or an IRA, you want to sit tight and hang on to your position. But as we've talked about before, the distance between this high and the low on this rising wedge is getting narrower and narrower, and therefore, you know, eventually something's going to happen. It's because everybody looks at this. These people that are trading the markets all over the world are looking at how this price is converging, and it means something. You have there's still a lot of bullish people in the market. In fact, I think tradefutures.com, or there's several organizations out there that track bullish and bearish percentage, and I want to say a week or so ago it was the highest it's been since 2008. So 2007 actually. So 2007 is should ring bells. That's when the market topped the last time. So I want to say we had 92% bulls a week or so ago. So, you know, these aren't things you make decisions off of, but they're important to know about because typically markets turn when everybody is on one side. So think of it like a boat. You're in a rowboat. If everybody's on one side of the rowboat, you know, the boat is tipping, and then it tips over, right? And when everybody tries to run to the other side, then it tips the other way. So when you have, and it's not a healthy way to be in a boat, right? So if everybody's on one side of the boat and it's about to flip over, that's kind of an analogy for the market, metaphor for the market. So let's just take a look while we're here at some of the other markets. We got interest rates. This is the 10-year Treasury note. So what you have over here is yields. So this 25.36 represents 2.536%. So what happens as the bond market goes up, yields tend to go down. So what's kind of happening right in through here and here is there's a little bit of fear in the market. So people running to the bond market, which are perceived as safe. One of the things I think I've talked about before, but I don't know how long ago, is the big money guys have to stay 95% invested all the time. This is actually by law. So they can't just sell stocks and go to cash. That's not even possible for them. So what they have to do is they have to move money. That's why you hear about rotation, things like this. They have to move money from places that are overvalued into places that are perceived undervalued, or places from high risk to places that are safe. And this happens on an ongoing basis. And in fact, that's what technical analysis guys do. They look for where the money flows are. And think of it like a surfer. You get on a wave in front of the big money guys, because they don't move in one day. It takes them weeks sometimes to move large amounts of money. And so you can ride the wave of their rotation. But you can see in the 10-year Treasury, we've had a little sell-off, some consolidation, and we've had this box on here for a while. This is our support zone. We're expecting the 10-year Treasury to hit this maybe 2.4% or so, and then resume higher. The expectation is that rates are going higher, and likely over the next decade or so, much higher. So that's what we're looking at here. Let's look at the euro dollar. The euro dollar is pretty important. It looks like the euro dollar has come into some support here. I would expect the euro dollar, it might make a new high. It might not. It might just kind of correct this move, maybe in a little zigzag fashion, and then resume lower. But in either case, it's in support right now. You wouldn't want to be selling the euro dollar at this time. In fact, you want to be a buyer, at least for the time being, of the euro dollar. Let's look at gold and silver. Gold is in a much larger. There's a much larger pattern going on with gold. Let's just look at it here. Let's zoom into this part here. Each one of these is a month, so you can see that gold topped back in 2010, kind of traded sideways, and then started to drift lower, and then really accelerated lower through this area here. And it looks like gold is trying to carve out a bottom, but it's also looking somewhat bearish right now. So you might look for gold to make a new low. If you're into shorting or buying puts, you could buy puts on gold and trade down to just below this low here. The support area would be just below this low from December 2013. On a more near-term looking chart, here's the low from December 2013. If you wanted to zoom in even more, you could see gold. You could see gold making, that's a pretty decent move if you wanted to trade that. So, or if you're looking to buy gold, let's go back to this chart here. If you're looking to buy gold, you might wait until it makes a low below this December 2013 low. Okay. Let's look at the Dow. The Dow looks, I don't know, it looks very sideways-ish, drifting up right here. If the market does tend to sell off, if it starts to sell off, you might see the Dow, lead up, just because the companies in the Dow, they're larger companies, they're not as volatile, and so a lot of money will flow into the Dow if the broad market starts to weaken. And you can see that the opposite thing happen here in the NASDAQ. The NASDAQ tends to lead the market up and down. It looks like the NASDAQ's getting into some resistance here. So here's a swing high, in a consolidation. And if you were to take a support, or excuse me, a resistance area off the NASDAQ, you might be looking at, you know, something like, whoops, it snaps to that. Let me try that again. You might be looking at something like, something like that. So, you know, with a gap up tomorrow, we could very well be into a level of resistance in which we might see the NASDAQ trade down. So this is just it's just what we see today. I mean, this is, you know, you don't really want to, I know we talk about, I don't want to talk about too much about what I think or anything like that. I want to just discuss what we see, because what I think is really not important. Everybody's got an opinion about the market, but if you're going to protect yourself, then what I want to do is help you make a decision about what we see in the market. And to me, that's much more important, because what you see allows you to be objective and allows you to make a decision. So I think that's a more, you know, valuable way to address the market. So, for example, what we see is we see this rising wedge on the S&P 500. The S&P 500 is a very broad index, and to see such a bearish pattern on that, I think it's probably not the best investment decision to be ignoring that. So we're watching it very closely. If it starts to look like a staircase down this way and it breaks out of this pattern, you know, we'll look for a place to make a decision. We'll publish that decision here on YouTube for everybody. But at the end of the day, you have to decide for yourself what's best to do with your money, right? It's your money, it's your savings, your retirement. It's your decision. I'm simply trying to help facilitate a good decision. And you know, if people want to generate a dialogue, let's talk about that. Incidentally, I haven't mentioned the email address on here before, but the email address that's linked to this account is middleclassinvestor@gmail.com. So I'll put that, maybe I can put that on the screen so it can be posted while you're watching the video. But it's middleclassinvestor@gmail.com. You can also follow me on Twitter @InvestorClass, or you can search on this YouTube channel at Middle Class Investor in the YouTube search window. I encourage you to forward the link to your friends, family members, anybody who you think would be interested in hanging on to their money, making more money, and staying out of whatever bear market might be around the corner. If you have any comments or you have any questions, you can post them on the YouTube channel. I think you do have to subscribe in order to comment. So to subscribe, you just hit the subscribe button. It's probably going to ask you for an email address or a username or something like that. But I think to comment, you have to actually subscribe. So anyway, happy Memorial Day, everybody. Thank you for coming in and watching the YouTube video. Tell people you know, forward the link, do whatever you can to spread the word if you find value in what we're talking about here. And until next time, again, right now I'm posting them once a week. If we start to see things, if things get a little bit more treacherous or something, we might increase that frequency to twice a week or something. But for now, just a once a week video. Anyway, thank you for coming in today, and happy Memorial Day. We'll see you next week. Thanks again, everybody. Bye-bye.